Hi everyone, this is Alan Frisbee, a life sales manager here at Financial Brokerage. I'd like to welcome you to the second part of our three-part series on business life insurance planning. Our partners today are with Lincoln Financial Group. Today we will be discussing buy-sell and key person insurance. You know, this type of insurance usually has higher premiums and higher commissions, and that makes it easier to qualify for our incentive trips here at Financial Brokerage. This year we have a trip to the Broadmoor Hotel in Colorado Springs. The Broadmoor is celebrating 100 years this year. It's a 5-star, 5-diamond hotel that also hosted the 2018 Senior Open Golf Tournament. We also have the Oak Lake Lodge and Outpost, a fly-in fishing adventure in Ontario, Canada. It's rated 5 stars on TripAdvisor. There are no roads to this lake. The only way in is by float plane. It looks like a great adventure. To qualify for the Broadmoor, you need $45,000 in total life premium. And to qualify for the Oak Lake Lodge, you need $35,000 in life premium. At Financial Brokerage, we also have annuities, long-term care, disability, and Medicare supplement. Those commissions also go towards the qualification. So let's try to get you some vacation time. I would now like to introduce two business insurance consultants from Lincoln Financial Group that will present to us today, Michael Deaton and Jordan Walker.
Perfect. Thanks, Alan. And thanks for those that joined today. For those that I haven't personally had the opportunity to speak with or speak to before, my name is Jordan Walker. I'm a business life insurance consultant here. I'm also joined with my partner, Michael Deaton. We're excited about today's session. When we look across, as Alan mentioned, it's the life insurance opportunities in the business setting, and where we actually see the majority of our business come from is from the two topics we're going to talk about today, succession planning and key person planning. When we look at business insurance in general, I always tell people to remember that business life insurance can be complex, but it's really rooted in three very fundamental risk management techniques. Making sure the business properly transfers, protecting the business against death of key employees, and also retaining top talent. So we're going to talk about the two areas of life insurance opportunity, once again, from a business standpoint, that we see the majority of our opportunities come from. I'm going to kick this off and specifically talk about one of, and Michael's nodding his head here because he probably agrees, one of the most overlooked opportunities in our marketplace from the standpoint of succession planning. There are, we'll say, a lot of small businesses, 29 million almost. Now, the majority of those, to be fair, are sole proprietors out there. The majority of these businesses, based on the research that we see, don't have formal succession plans in place. And as you can imagine, this isn't necessarily a direct life insurance conversation, but it's a very important conversation to have with the business owner. One of the most common solutions to have in place upon, of course, death of an owner is life insurance to help secure value of the business and purchase deceased owner shares. I'm going to talk specifically about the most important question that we should be asking the business owner to begin with. Second, I'll go through why succession planning is important and some of the pain points that happen due to lack of planning, and then I'll close out with simply why life insurance and kind of bring it all back to the core of what we sell here at Lincoln in the business market. So let's start here. It all comes down to this question, right? Mr. and Mrs. Owner, if you became disabled, you retired, or you passed away, who would take over your business, right? You would be surprised how many people don't know really the answer to this question. It's kind of sad to think about, but also on the other side of that coin, there's a lot of opportunity here for us as insurance professionals and as financial professionals. Basically, the premise of succession planning really revolves here. Now, we're going to talk about specifically what would happen in the event of death, but you'll find that a lot of business owners think that because they told their spouse or because they told their attorney, because they told their CPA what they want to happen with their business, or they want a specific thing to happen with their business, unless it's properly documented and properly funded, the likelihood that that's going to happen is almost 0%. So we'll talk about a couple of those nuances in particular today. Here is why the actual buy-sell agreement is important. It's going to help to do a couple things. One, it's going to help protect the continuation of the business with little interruption for employees, customers, and creditors. So having an actual succession plan that's properly documented is going to specify who buys the business and at what formula you use to value that business at the time of the purchase. The second point I'll make with regard to why having the agreement in particular is important is because it's going to help protect the financial security of the owner and his or her heirs in the event of death, once again, disability or retirement. So think about this. If you happen to work with small business owners, one of the things that you know is that business represents the majority of their net worth. So lack of planning for death, disability, or retirement, if we have one of these events occur and the main revenue source for the family is the business, then we could, of course, be in trouble, right? So we have to have the proper insurance products, the proper funding mechanisms in place to help protect the financial security of the heirs of that owner or owners. And then just simply by going through the succession planning conversation, I'll talk a little bit about how we do that. We have to establish the value of the business. So most small business owners, based on our experience, Michael can probably vouch here, they don't know the true value of their business, or if they do, it's usually not valued properly. So the process of going through discussing succession planning leads us down the road of having to get a value for the business, which just further helps that conversation. So if I had to give my usual 3 steps, this is really simplified, of the succession planning process. The first would be valuation. The second would be documentation. And the third would be funding. And we're going to talk about funding in a minute. But we got to establish a value. We have to properly document with the buy-sell agreement, and we have to properly fund that arrangement. My biggest piece of advice here with regard to valuations, there are a lot of very simple informal informal processes that you can go through to get an informal valuation. For most businesses, I suggest getting a formal appraisal or formal valuation done. It's going to get you within a very, very close range of what the business is truly worth. I typically have advisors or producers work with a valuation expert in their particular area, because that individual can really get a feel for what other businesses like that business have sold for, what the market's like. They're going to be able to really help the business owner peg that value. And then also, in conjunction with the valuation expert, working with an attorney, a CPA, to make sure that all this comes together. And then you've got us from a life insurance standpoint that we can help support the funding of it from a death standpoint. So let's look at just quick impacts and the importance of valuing a business. Our biggest thing that we pull out here is the estate planning piece and the business continuation piece. Creditor relationships tend to be something that can be impacted upon premature death of an owner. But for the most part, when you're really talking about with a business owner, the importance of valuing their business is for estate planning reasons, because one, the business represents the majority of their net worth, but also from a business continuation standpoint. If this business owner has any want at all for this business to continue beyond their retirement or beyond their death, having a true value of what that business is going to be bought or sold for is extremely important. So just a quick, easy chart here. Odds of death before 65. I'll just summarize this and say, as the number of partners in a business increases, so does the odds of death. These numbers look very, very fancy, but at the end of the day, if you think back to simple odds here, the more people, the higher odds that we have a death prematurely before 65. But I do want to point out to you that when we're dealing most of the time with succession planning cases, there's usually 2 or more owners. So, always use this slide to ask a question. If you knew that there were a 34% chance that you would leave work today and get in a car accident, you would probably want to insure that particular risk. If there's a 34.1 or 27.9% chance of death before 65, I would probably look at the proper risk management techniques and products to make sure that my business is properly secure. So I use this particular slide to explain that. So failure to plan. I usually get this phrase wrong, but I'll try to get it right this time. One of our former partners in this area used to say, not having a plan is still a plan, it's just a plan to fail, right? And when you look at it, there's a couple of different or many consequences to not having a true buy-sell arrangement in place. One, we see this whole notion of having to sell the business at fire sale prices or a business assets at fire sale prices. That could be for many different reasons, revenue, it could be for tax purposes, whatever that is. But not having these plans properly funded could result in some type of rash, quick decision to sell assets or the business at a price that's valued far less than what it's worth. The second point here, without proper planning, we know that the business represents the majority of revenue for most families. Loss of primary sources of income could have a tremendous impact there. I'm not by any means suggesting that the succession plan itself or the product itself, from a life insurance standpoint, is going to make all those woes go away, but I can assure you from personal experience that having the life insurance product in place can really help, especially with the loss of primary source of income for the business owner and their heirs. Demand by creditors for debt settlements, we see this sometimes be an issue. Someone passes away, they become disabled. It's important to review those loan documents for any outstanding debt because there could be a call on outstanding debt for the business. So it's important to have insurance for that particular reason. And we all know, once again, estate taxes, liquidating assets to pay, estate assets to pay business debt. I would also lump into this liquidating business assets to pay estate taxes as well, especially for our higher net worth businesses. So now that we've talked about the costly mistake of not planning, let's go into common buy-sell plan options. Now, I'm going to really talk about two. There's a lot of different plans out there, a lot of different variations of them. You can almost be rest assured that they either derive from a cross-purchase arrangement or an entity arrangement. And I'll go through each of those here. I'm not going to go through wait and see. I don't see too many of those. I'll stick to the ones I see most common. With a cross-purchase, each owner is going to enter into an arrangement with one another. Okay, so if Michael and I are partners in a business and we enter into a cross-purchase arrangement, I, on paper, agree to buy shares from Michael's estate or from his spouse in the event that he passes away or becomes disabled. Okay, from a life insurance standpoint, to cover the death obligation there, or the obligation to purchase if a death occurs, we would own, in a cross-ownership fashion, life insurance on one another. So I would own life insurance on Michael, he would own life insurance on me. That way, if I pass away, the death benefit proceeds go to Michael, Michael goes to my wife and my lovely 2-year-old golden retriever, Winston, and purchases those deceased, my shares. So that's a basic cross-purchase. I'll walk through with a graphic in a minute how that works. And then the other type we typically see is an entity purchase. So same arrangement here. There's an agreement in place to buy shares, but it's with the business. Okay, so the business is in an agreement with Michael and myself. That way, if we pass away, the business goes to our estates and purchases those shares of that business interest. So commonly, a cross-purchase arrangement works very, very great with two individuals. The more individuals that you add to this, the more complex it gets, because you have to think especially from an insurance standpoint. If you do a cross-purchase arrangement and you've got 8 owners, that's almost 56 life insurance policies you'd have to have. So it gets complex. So typically, when we have more owners, an entity purchase or entity redemption is probably more appropriate and a lot easier to administer. I'll walk through with a graphic here how the cross-purchase works. So if we've got owner A and owner B, we'll assume owner B unexpectedly passes away. The first step in this process is to establish the arrangement. Right? The second step is, if we're funding this with life insurance to protect in the event that one of these individuals passes away, owner A would purchase the policy on owner B, owner B would purchase the policy on owner A, and in the event of death, right, of owner B, the life insurance proceeds pay to A. A then goes to the estate of B and purchases those shares. So assuming we've got death of B here, after step 4 would be step 5, owner A is 100% owner of the business. You know, businesses love this for a couple of different reasons. If you've got if you have Two owners is very simple. Most attorneys know how to draft a cross-purchase arrangement. Keep in mind that this is an arrangement between these two individuals outside of the business. So if owner A here in this example is Michael, and he gets death benefit proceeds if I die, owner B, he's got those proceeds in hand, and he's going to the estate and purchasing those shares. He gets to step up in basis for that. So essentially what that is, you get to step up in basis. Any future consideration for growth of the business reduces that tax exposure. So it's great from that standpoint. Once again, the downside here is if you have multiple business owners, it gets a little bit complex, and we tend to lean on, in that case, the entity redemption. So real quick, entity redemption is really easy. Business step one enters into agreements with the individuals, not the individuals between themselves, the business and the individuals. They're going to, from the business standpoint, purchase life insurance in the business, and the business is going to be the beneficiary of that particular life insurance. Same deal here. If B passes away, or in any case, if you become disabled, and this was disability insurance, it works a similar way. If he passes away, proceeds pay back to the business. The business then goes to the estate of B to purchase those shares. Downside being, there's no step up in basis for this transaction because the business did that purchase. The positive thing here, and the easy thing to talk about, is the fact that if there's multiple business owners, it becomes a little bit more easy to administer and purchase life insurance for. So just wanted to show you at a high level how these arrangements work. This by no means is a very simple conversation, but we always encourage individuals, if you're going to be talking about the importance of buy-sell planning and the insurance associated with it, make sure that you've got a good team of advisors, right? Make sure you have partnerships with CPAs, with attorneys, so that we can help, in total, life insurance professionals too, really do a good job for these business owners, because this is probably one of the more complex areas of planning, but one of the most important in my opinion. Let's talk really quickly about why life insurance before I pass it on to Michael. 3 key points I'll make here. Life insurance, when you talk about true risk management, this is probably the most simple product to actually introduce into this solution. Life insurance, right? Readily available cash to purchase each owner's interest. So it's there when you need it from a death standpoint. Cash values may be accessed as a source of funds for a living buyout. So I would say that there's more living buyouts than death buyouts. Most of the time, term insurance is used to fund a buy-sell. We do see some situations in which permanent cash value life insurance is used. In some cases, it's because of the actual business type. Construction companies, car dealerships, they tend to keep money on their balance sheet, so they like permanent cash value life insurance. But also we see cash values being accessed to provide some source of maybe a down payment for a living buyout. I use down payment lightly. I'm not suggesting by any means that life insurance cash values can provide all the funds needed from a living buyout standpoint, but it certainly can help. Then we, of course, have the core value proposition of life insurance here. If it's structured properly, those proceeds are received income tax-free. So these 3 key points here are really the why life insurance. So now that I've talked about buy-sell planning and buy-sell insurance, I'm going to transition over to Michael and have him talk quickly about key person life insurance. To kind of tee this up really quickly, next to succession planning and funding properly buy-sell arrangements, key man life insurance is the most overlooked opportunity in the business life insurance marketplace. Everybody has heard about it. Everybody says they talk about it, but we tend to see a low implementation rate based on the research that we get. I'm going to have Michael set this up, talk about what key man is, and talk about some of the common considerations that we use for this strategy.
Thank you, Jordan, and good afternoon, everyone. Again, my name is Michael Deaton, a business insurance consultant, and what I want to really kind of do is piggyback off of what Jordan was talking about as the foundation of risk management for business owners, which is starting with that succession plan, securing the business owner's retirement first. But then as we work through that process, really it allows us the ability to transition conversations over to those key individuals in our organization that are critical or vital to that business owner's success and continuity. And oftentimes, as Jordan was just outlining there, the succession process, sometimes these key individuals are part of that buy-sell planning process. So who are these individuals? So there's really not a specific definition that applies to all business owners, but kind of the umbrella, if you will, are going to be those corporate officers, experienced managers, technical or subject matter experts that are integral to helping that business owner develop, grow, and drive success in that organization. You know, these individuals may oftentimes maybe have a sales background and are often responsible for driving a large amount of the direct revenue for a business. So what is that impact of losing that key employee to a premature death or disability going to do to that business? And here it's really helping that business owner identify those key people within the organization. We'll step back for just a second. I think what we find, and a lot of times with our conversations with producers, is that to a small business owner, everyone is key, is critical to the day-to-day operations and the success of that business. But it's really drilling down with that business owner on those key individuals that are really responsible for driving the success and growth of his or her business. So when we're talking about key person coverage and then working through the helping that business owner identify those individuals that are critical to the success of that business, we also have to help that business owner understand the impact, really disturbing them around what it means to that business, what kind of disruption would take place if that key person was to no longer be with that business. You know, who will take over their duties and responsibilities? How long is it going to take that business owner to find a suitable replacement? What is it going to cost the business to be able to go out and attract new talent to fill these persons' responsibilities? One of the things that's not necessarily addressed oftentimes is what is the morale impact to a business? So not necessarily the financial disruption, but what about the overall morale disruption that can happen if you've got one of those key individuals that happens to lose a business? So not only can we see financial disruption, but there can be just day-to-day disruption when you have a loss of a key employee. So again, part of this approach with your business owner clients is to help them understand that impact, to kind of disturb them, unfortunately, about the pain that it could come with the loss of a key employee. So what's the solution? So really what we're bringing to the table for our business owner is a conversation around those, one, identifying, two, helping them understand the impact to the business, and then lastly, it's providing a solution. And that solution oftentimes is done with life insurance, and it provides for that business owner a very simple and cost-effective way to give financial stability to that business owner. It's going to, in the form of death benefit proceeds, give immediate liquidity to help meet day-to-day operational needs such as debt settlements. If you have a key employee that was a strong client relationship manager or sales driver, it can help to cover the shortfall in lost profitability while we go out and recruit or help that business owner recruit and train a new replacement. The other part about key person life insurance, obviously from a risk management standpoint, we're helping protect the business, but because these policies are corporately owned, with the corporation also being the beneficiary, we now have, if we're using permanent cash value life insurance, the ability to multi-purpose these policies. It could be to, as Jordan talked about just a little while ago, help to use for living buyouts, or as we'll talk about in our next session, maybe a way to structure an executive benefit program. So life insurance becomes a very flexible solution to help the business owner not only protect the risk of losing that key employee to a death, but also gives the business some future financial flexibility to meet additional business needs. So how do we value a key person's impact to that business? There's a variety of different ways, and this really is speaking to helping underwriting understand how you arrive at a coverage amount, helping underwriting through that sales process, that calculation method. Within the industry, we have several different methods that are commonly used. I think one of the ones that Jordan and I see probably the most is the multiple of salary. You know, an individual making $100,000, we may see a death benefit need to help protect that business of 5 times their income, so $500,000 of coverage. And that can often be inclusive of other forms of compensation like bonuses or stock options. Another way that we see business owners or helping business owners value those key employees is the percent of profits. And I think this really speaks to those individuals that are maybe key sales individuals that are drivers of revenue growth from the sales side, or maybe they're operational folks that are integrals on product development. So what do these individuals bring in terms of a percentage of profits to that business, and backing into that for a coverage amount needed for each of those individuals. And then lastly, one of the common things that businesses use to help grow their business is also leverage or debt. So when we're talking about key person coverage, this can include business owners or key individuals themselves. We oftentimes use key person life insurance coverage to help satisfy any debt coverage or debt outstanding in the event of a premature death of a key employee or a business owner. So how does it work? I touched on this just a minute ago. The policy will be owned by the employer, but first what we do have to do is identify our key employee and obtain their written notice and consent. This is to satisfy an IRS 101J requirement that employee provide written notice and consent for the employer to be able to receive those death benefit proceeds on a tax favorable basis. As the employer being the owner of the policy and beneficiary, they're also making premium payments to the life insurance carrier. Those premiums are often oftentimes non-deductible. So you can see through this flow diagram that once we've got our notice of consent, our key employees are insured, employer owns the policy, is the beneficiary, so we've got this complete solution to help the employer maintain coverage for the risk if we lose that key employee to a death. So how can Lincoln help bring some additional sales concepts to your practice? We actually have within one of our illustration softwares the ability to help you illustrate key person coverage and help present the valuation components to your business owner clients. And so that's one of the things that we find is oftentimes a challenge for a lot of producers is how do I take something that is often viewed as complex to my business owner and help simplify it? We have these client-ready presentations, client-friendly presentations that not only help them to understand what key person coverage is, the valuation methods, but also how that can impact their business financials. Oftentimes, again, with these being corporate-owned policies, there can be some considerations on what types of products we use to fund the key person need, and these presentations help with that conversation. So lastly, we just want to close. I mean, today we really touched on two foundational pillars of risk management that business owners face. The buy-sell succession planning, helping business owners efficiently transfer interest and managing the risk if one of those owners passes away prematurely. And then also helping business owners identify those key employees that are instrumental in driving success for that business owner and the financial impact and disruption that could cause to those business owners if we didn't have the proper risk solutions in place. And so as we move forward into our next session, we want to build on this and transition conversations to our third pillar of risk management, which is how do we help retain and reward key employees through executive compensation strategies. So again, my name is Michael Deaton, Jordan Walker. We really appreciate your time this afternoon, and that concludes our prepared conversation for today. Alan, we turn it back over to you.
Well, guys, I just want to tell you how much I appreciate that. It seems like every time I, watch one of these webinars, I learn something new, and again today it happened. I was noticing that the last one that you did a couple weeks ago, I rewatched that one, and you always learn something new, or you may not have heard it the first time. So I just want everybody to know that these webinars, we are going to send out a link with the video that we just heard today So if you want to rewatch it, and I've already had a couple agents contact me while this was going on. Sorry, I missed it. I need to watch it. Make sure you tape it. So there's a lot of good information here. Just want to tell Michael and Jordan how much I appreciate you guys, and look forward to the next one on September 11th.
Sounds great. Thank you so much.
I didn't have any questions here, so we'll just leave it at that. And if anybody has any questions, you can always email us here at Financial Brokerage, and we'll get them to Michael and Jordan and get responses back to you. Just want to thank everybody for attending today.